Hello all and welcome to BDO Christchurch's presentation of this Financial Fundamentals webinar. My name is Sarah Vivian. I am one of the PAs here at BDO Christchurch and I'll be your moderator today. Before we begin, I want to note some of the ways to interact and move about during this webinar. Your computer or phone audio settings will be where you can adjust the volume and the device you are listening on. All attendees are in listen-only mode, which means you cannot share audio and video throughout the duration of the webinar. Please feel free to hit the speech bubble with the question mark in it at any time during the webinar to ask our presenters any questions about the webinar. You can tick the anonymous button if you wish. See the red box in the corner. We will attempt to get through as many questions as we can at the end of the webinar. If for any reason you need to leave the webinar, you can do so. The link that you need to join will still work if you wish to rejoin while the webinar is still live. If you are having any issues with the software throughout, there is a Need Help link which may help, or else send us a question in the Q&A tab and we will endeavour to fix this issue for you. I want to also note that following the webinar, we will send out a recording to all registered attendees. So if you miss any of the webinar or would like to refer back into the future, you can. I'm pleased to introduce you today to our two presenters, Sam Rogatsky on the left and James Sheehan on the right. This webinar should run for around 60 minutes, including Q&A time at the end. I will now pass over to Sam to get started.
Thank you very much, Sarah. That's awesome. Just get myself sorted from my end. Sorry, guys. Great. So welcome to you all, and thanks for joining us here for BDO Christchurch's webinar on understanding your financial position to grow your business. James and I are co-presenting today, so please bear with us as we transition back and forth. We'll try our best to make it as seamless as possible. So here's what we're going to cover in this session. We'll talk about the balance sheet, the story it tells us about our business, and discuss some practical and proven strategies for a stronger balance sheet. We'll also cover your 4 most important areas of focus, as well as your next steps and how we can help you on that journey, and of course followed by the Q&A. So any questions you have, get them in at any time and we'll answer them at the end. Right, so often we see business owners focusing all their energy on the profit and loss. In other words, the statement of financial performance, looking at ways to drive up revenue and drive down costs. This is important, but without a focus on the balance sheet, profitable businesses can and do go broke. For example, if you drive up sales, but you don't have a great system for invoicing your clients or collecting the money you're owed, the business can run out of cash. Likewise, a growing business may overinvest in stock and then, in a downturn, find it difficult to move the stock and convert it into cash. Cash is often described as the oxygen for the business. There are many ways to increase cash flow, which we'll cover shortly. The balance sheet is where your cash is measured. There are some really useful calculations that can be done to show how much cash can be created by influencing other numbers on the balance sheet, such as debtors, stock, and work in progress. Now, your banker will look at your balance sheet from time to time to see if your business is solvent, and so should you. Trading while insolvent is not only stressful, as you'll find it very difficult to pay the bills, it also potentially puts you personally at risk with creditors, the tax department, and financiers. Today, we'll show you how to test at a glance to see if your business is solvent. Now, in a downturn particularly, but as a general rule, it's important to make sure you're not drawing too much out of the business for your personal spending. Tax bills generally lag behind the revenue that you're generating. So you could find yourself in a position where a surprise tax bill can't be paid because you've taken too much money out of the business for your personal spending. Having and being accountable to a personal budget is a great way to keep in check with what you're able to draw out, and we strongly recommend that you all have one. Having a war chest of cash is essential in times of economic downturn. If your profits are down, if you're making a loss, a strong balance sheet will help you see through until the profitability is restored. Now we know why we need to focus on the balance sheet. Let's talk about what it actually tells us. Your balance sheet, also known as the Statement of Financial Position, provides a snapshot of your business's financial position at a specific point in time. It measures the net worth of your business, which is the business's assets less the business's liabilities. It also shows if your business is solvent. If your liabilities are greater than your assets, then the business is insolvent and urgent action is needed to fix this. You can also compare different periods to determine whether the business's net worth is increasing or decreasing between years and gives an indication of the strength of the business. Remember, the stronger your balance sheet, the easier it will be for your business to survive a downturn. It also provides a basis to calculate key ratios such as debtor days, inventory days, and working capital, which can all help to understand more about the strength of your balance sheet. So, to put this all into play, what we're going to do now is go through an example balance sheet that we've made up and show all the key components and what they tell us about a business. So, for our example, we'll use an imaginary building company. The first part of the balance sheet is the equity or owner's interest in the business. You can see here that last year, the company made a profit of $71,554, but this year it's made a loss of $45,857. Total equity is $2,087, which means if the company makes a further loss, it will be insolvent. Strategies to improve profitability will need to be implemented in this business. So we'll build the balance sheet as we go to help you understand this layout. The company has a bank current account, but you'll see shortly that it's also running an overdraft facility. A current account like this is a great way to build up cash reserves for tax payments and any other further downturn in trading results. There's income tax receivable here, or in other words, a tax refund due of $5,375, which means that too much tax has been paid during the year, so there is a drain on cash flow. Most of the time, people get excited about tax refunds, as you're surely aware, but in reality, in most cases, it means you've paid too much tax too early. The opposite can also happen where there's a surprise tax liability when the financial statements are done, which can put pressure on cash flow. The takeaway from this is that having a regular update of your tax position throughout the year helps ensure you don't pay too much or too little tax. Now, we are usually very well positioned to help you with this and can help you to understand your tax position at any point in the year. So there's our balance sheet so far. Now, stock on hand has increased by $33,862, which is another drain on cash flow. Holding too much stock can put pressure on a business, as that stock first has to be sold, and then the funds need to be collected from those debtors. However, the amount of stock needing to be held in a business is different for every industry, so you guys will know more than any what a comfortable level of stock on hand looks like. Keeping an eye on your stock level will be key in identifying if you are under or over investing in stock. On the flip side, work in progress has reduced by $47,531, which is good news, as the higher the amount tied up in unfinished work, the longer your cash is tied up. In this example, work in progress is made up of the wages paid on jobs that cannot yet be invoiced to your customers. Adding a little bit more onto the balance sheet there. So now we have the shareholder advance account, which we also call the shareholder current account, which is showing an asset of $66,494. In other words, the shareholders owe this money back to the company. Now, as you can imagine, this isn't ideal because if the company fails, a liquidator or receiver can demand this money from the shareholders and they won't have the protection of limited liability and will be personally liable. On top of this, the IRD requires interest to be charged, which creates more tax payable for the business. We can also see that the balance owed has increased by $32,504 this year in the shareholder current account, which indicates that these shareholders are taking more cash out of the business than what they're entitled to. Now, accounts receivable, or debtors, have reduced to 82,628, which has freed up a bit of cash compared to last year. Now, if we refer to the profit and loss, which you can't see here, we can calculate that it is taking 48 days to collect debtors, and we'll show you that calculation soon. If payment terms for this building company's customers are 7, 14, or even 30 days, we can clearly see that there's a significant amount of cash tied up here. Now, there's very little value tied up in this company's fixed or non-current assets. This could be a signal of eroding value, as the fixed assets have dropped by $23,588. In other words, some fixed assets could be in need of replacement. So again, there could be a future drain on cash reserves when assets need replacing. Now, although the total reduction in total assets this year is only 15,492, that is the reduction down from 297,982 down to 282,490, we need to remember that one of these assets that has increased is the debt owed by the shareholders to the company. So if we remove that, the true asset reduction is in fact $47,996, which is of major concern. So those there are our assets. Now let's look at the other side, our liabilities. So we can see that the Visa account balance is considerably more than it was at the same time last year, which could be a symptom of poor cash flow. It doesn't necessarily mean it is. Credit card accounts will always need to be cleared in full each month to avoid high interest costs, as you may know. If you're unable to pay your credit cards each month, it's important you talk to us about how to restructure your finances to avoid these high interest costs. The bank overdraft has also increased from $36,734 to $38,236. We need to understand what the overdraft limit is and how close the company is running to this limit throughout the month. Often the most difficult time of the month for cash is not necessarily the last day of the month. For example, it might be the day wages, suppliers, payroll taxes, or all of the above are paid. So we need to make sure that there's a buffer of cash in the overdraft. Another point to consider here with the overdraft is that if the overdraft facility never goes below, say, 20,000, then that 20,000 is considered to be core debt, and you could actually refinance that into a business loan to reduce your interest costs. Okay, so GST is what we refer to here as lumpy expenditure, as it's not generally payable every month or every week, with the most common GST filing and payment frequency every 2 months. A good strategy here to preserve cash flow is to put aside a set amount each month for GST, as well as your other taxes. I already talked about using the bank current account to build this up for this purpose. If you talk to us, we can help you work out how much you should be setting aside each month for tax payments, so that you always have sufficient funds available. Note here that last year, the tax payable was $15,747. And if you remember, this year there's a tax refund owing. By having regular updates of your tax position, large fluctuations in tax payable can be avoided, which again reduces cash drain and your stress levels. Just want to note here as well that there's a loan for a phone. Asset finance interest rates are often a lot higher than bank finance. So always be careful accepting finance deals on things like phones, vehicles, or other equipment needed in your business. We do note that sometimes it's better for cash flow purposes to use asset finance though. Again, we can help you with decisions like this that you may be considering, such as buying outright versus financing. Perhaps the biggest indication of cash drain in this business is that trade and other payables, or your creditors, have increased from $72,482 to $111,418 this year. If we refer to the trading account's cost of sales, which again can't be seen here, we can calculate that it's taking 74 days to pay suppliers on average. Last year, was taking 47 days. Not having the sufficient cash to pay suppliers each month is incredibly stressful as well as risky. Again, we'll look at how to calculate this soon. So we can see here that the company refinanced loan 7.0 with loan 7.1. Now, in the current climate, refinancing such as this may result in reduced interest costs, but on the other side of the coin, we also need to be mindful of the legal and loan application costs that may outweigh this. So the bottom line there, with net assets of only $2,087, the company has no ability to borrow any further funds, or it will fail the second test of solvency, which is to always have assets greater than liabilities. And we'll go into this in more detail shortly. So, with the reduction in net assets of over 45,000, we need to be thinking about how we can bolster or strengthen this balance sheet to reduce risk. Let's now switch to thinking about some strategies you can look at to strengthen your own balance sheet. I'll pass you over to James to take you through it.
Thanks, Sam, and good afternoon all. In the current climate, it's likely that many company balance sheets will have taken a hit from a downturn in business. It's important to focus on what you can control and adopt practical and proven strategies to bolster your balance sheet. There are 4 areas of focus for building a balance sheet strength. Focus on increasing profitability, which is incredibly important in the current climate. Focus on improving cash flow. There are a number of ways to do this, which we'll explain shortly. Focus on solvency. That is whether your business can pay its debts as they fall due and whether assets are greater than liabilities. Having real-time, up-to-date information is very important to determine solvency. And lastly, focus on your shareholder advance accounts, as these measure whether you're taking more funds from the business that are owed to you as shareholders. Having a dividend and drawing policy is essential to ensure that you don't end up with an overdrawn advance account, as liquidators can chase you personally for the balance owed. Revising your personal budget is an important action if you haven't done so already. The first of our 4 areas of focus is profitability. The best way to increase your profit is to choose a couple of the 7 ways to grow your business that you see as most relevant and best suited to building profitability in your own business. So as we go through these 7 ways, make a note of the most relevant for your business. To increase customer retention, build a plan to keep your customers happy and well looked after. Keep the relationship strong and deliver good quality work so that customers remain loyal and don't defect the competition. Maybe even try a customer survey to see what they like most about your goods and or services and hone in on that to keep them happy. To generate more leads, focus on your marketing, especially via referrals, testimonials, and social media, as these are all relatively cost-effective strategies. In this digital age particularly, there are many social media avenues you can go down, and the more often a potential customer sees your business, the more likely they are to remember the name and find themselves interested. To convert more prospects into customers, look at strategies that will increase your proposal, quote, acceptance rate. Perhaps some sales training could be in order here. To increase your transaction value, implement strategies to encourage customers to spend more time with you every time they buy. Perhaps offer options to upsell. Pick up on that very well-known concept of offering fries with that. Again, this can be specific to the industry that you're in, so consider strategies that are most relevant to your industry. To increase transaction frequency, look for ways to encourage your customers to buy from you more often. For example, offering loyalty benefits, a reminder service, or simply staying in contact with your customers so you're always front of mind. To reduce your variable costs, identify strategies to eliminate wastage and rework. Also consider negotiating better pricing with your suppliers. And finally, to reduce overheads or fixed costs, review these at least annually to ensure that you're getting the best deal and that they are still required. For example, if more of your team are working from home, you could downsize your office space to reduce rent. Or could you get a better deal from your utilities by changing providers? It's a simple case of shopping around. It's important to be careful that you're cutting the fat and not the muscle. Some overheads could be seen as investments. For example, investing more in your accountant to help grow your business. Seriously though, if you see us as a cost, we should be cut like all other costs. But if you see us as a strategic partner in helping you run a better business, we'd love to work with you more. We literally have hundreds of practical and proven strategies we can help you with in each of these 7 areas and can help you identify what strategies are best for you. The second area of focus to bolster your balance sheet after building profitability is to improve cash flow. The cash conversion cycle shows how long it takes to receive a payment from your customers after buying stock from your suppliers. In other words, how long your cash is tied up in inventory and accounts receivable. Let's take a look at an example. We buy stock from our suppliers on day 0. We pay for that stock 35 days later. It takes on average 65 days to sell the stock to customers. This means our average stock holding is 65 days. It takes on average 110 days to receive payment from customers. So our average receivables is 45 days. It takes on average 110 days to receive payments from our customers. So our average receivables is 45 days. To calculate our cash conversion cycle, we add our average stock holding and receivables days together, then take away the average payables days. This gives us a cash conversion cycle of 75 days. Do you know what your cash conversion cycle is? I think it might be a good exercise to go back after this webinar, look at what your cash conversion cycle is in your own business. You might be quite surprised at how long it takes for the cash to come back. Ultimately, cash is king. And you can see from our example before, you want your cash conversion cycle to be as short as possible. The more cash you have in your business, the stronger it will be and can weather the downturns and ride through the slow months more easily, as Sam touched on earlier. Technically, if you increase your cash by collecting your debtors, your net assets don't improve as debtors go up while cash goes down. However, the higher your debtors are, the more risk there is of non-payment. The same goes with inventory. Turning inventory or stock on hand into a receivable by selling that stock does not affect the net assets as debtors go up while inventory goes down. But it does mean that there's less likelihood of stock going obsolete or out of season and more likelihood of it turning back into cash when the money is received from the sale. Therefore, the quicker you can convert your debtors and inventory into cash, the stronger your business will be. If you can negotiate better terms of payment with suppliers, you can preserve your cash flow for longer. Care is needed here though, as in the current economic climate, slow payment of suppliers puts a real drag on the economy. What's important here is to come to an agreement with suppliers. For example, they might agree that you only pay for your stock when you've sold it to your customers. You must also look at how long it takes for your stock or work in progress to be invoiced. The quicker the better. Consider the most comfortable level of stock you can hold. Not too low that you miss out on sales, but not too high that you run out of cash. Or if you can progress invoice, to reduce the number of jobs you have on the go at once. Make sure you're also keeping a close eye on how long it is taking for your debtors to pay you. There are so many things you can do to get paid faster, like updating your terms of trade, automated or repeated invoicing, or simply chasing up your slow payers with a systemized process or credit manager. Let's look at some examples based on our building company. So going back to our building company, we can see that inventory is taking 38 days to sell, whereas last year it was only taking 15. If we can reduce the days by 9, we can free up $13,503 in cash. Work in progress is taking 10 days to invoice, which is much faster than last year, which was 41 days. If we implement weekly progress invoicing and reduce this by a further 5 days, we can free up another $7,502 in cash. Out of interest, look at last year when it was taking 41 days to invoice work. If we have reduced this by 25 days, we could have freed up $38,500 in cash. Debtor days have been pretty consistent between 45 and 48. If we can reduce them by 18 days, so it only takes 30 days to get paid, we'll free up $31,141 in cash. If we add to the cash we could free up by reducing our inventory days, work in progress days, and debtor days, we would free up $52,146 in cash, or over $90,000 last year. It's taking 74 days to pay our suppliers, which isn't sustainable. We need to reduce this by at least 30 days so that the company is staying current on the payments owing. This requires $45,000 in cash. So if we take the cash we've received earlier of $52,146 and deduct the $45,000 we need to repay our creditors earlier, our cash flow would improve by $7,136. Remember, that is not only our cash flow improving, but also our relationship with suppliers as we are paying them quicker. The key thing here is that life will be so much less stressful for the owners of the company, not having to wait so long to be paid, thus being able to pay suppliers in a more timely manner. So to recap, our first strategy was to build profitability, and the second, to improve cash flow. Now we're on to our third area of focus to bolster your balance sheet, was to maintain solvency. As mentioned previously, there are two components of solvency, often referred to as the first and second limbs. Firstly, the ability to pay debts as they fall due, which is measured by ensuring that current assets are greater than your current liabilities. The second part of this test is ensuring that total assets are greater than total liabilities, not just the current ones. Let's go back to our example building company once again. Here we've taken the current assets and current liabilities section of the balance sheet to calculate our current ratio. Your current ratio tells you if you're able to pay your debts as they fall due. For classification, the term current refers to assets and liabilities that are expected to be realised or settled within the next 12 months. Anything older, such as term loans with the bank or property, plant and equipment, is generally classified as non-current. The current ratio therefore picks out the most immediate liabilities and assets. To calculate the current ratio, we divide total current assets by total current liabilities. We can see in 2020 our current ratio is 1.31. This means for every dollar of debt, there is $1.31 of current assets available to settle it. However, we need to adjust out the shareholder advance account because this is not a true realistic current asset, and that the shareholders are not going to pay this money back within a month or two, and it is not really to do with the business operation, more to do with what the owners have taken out and put in. Now we can see that for every dollar of debt we had to pay, there's actually only 92 cents available to settle that debt. The company is technically insolvent, and we don't have the ability to pay our debts as they fall due, the first component of solvency. To fix this in the long term, we need to go back to our first strategy and increase profitability. But for the short term, however, the company either needs an injection of cash from the shareholders or part of the bank loan needs to be converted to a term loan. I'll talk more about the shareholder advance account shortly, but first let's look at the second part of the solvency test, with total assets being greater than total liabilities. Our net assets, or total assets less total liabilities, appear to be positive at $2,087. However, if we exclude the overdrawn shareholder advance account, the company is actually insolvent by $64,407. The company either needs a short-term cash injection of, let's say, $70,000 in round terms. By doing this, we can eliminate the bank overdraft, and the shareholder advance account becomes a liability of $3,506. True net assets are now back to $2,087. Of course, the company still needs to implement the previous strategies to increase profitability and cash flow, but at least now the two limbs of the solvency test can be satisfied. This brings us really nicely to the fourth area of focus to bolster your balance sheet, managing shareholder loans. We've already covered the risk associated with an overdrawn shareholder advance account. The main risk is that if your company gets into financial difficulty and a receiver or liquidator is called in, your personal assets may be at risk as the loan is likely to be called up. A great way to avoid an overdrawn shareholder advance account is to update your personal budget so that you can reduce the amount of drawings you're taking from the company. Personal budgeting is a rewarding and empowering thing to do, especially in the current economic climate. Now, when we talk about shareholder advance accounts being overdrawn, we're talking about drawings that don't relate to a shareholder salary you receive when the accounts are prepared at year end. There are a lot of businesses out there where working shareholders don't get paid a PAYE salary, i.e. through the payroll. Instead, they take regular drawings from the company equal to a salary that gets credited to them at year end. As you go on drawing this down throughout the year, it will cause the shareholder advance account to become overdrawn, as the corresponding salary hasn't been added, which is normally done by your accountant at year end. You don't have to worry about this being a problem. It's only when the amount you're taking exceeds the salary you get. While we're on the topic of personal budgeting, set a regular, weekly, or monthly amount that you take from the business and stick to it. Again, we are well equipped to have these conversations with you about figuring out a comfortable weekly drawing, setting you up on the payroll, or even helping you with your budgets. And lastly, to protect you in the event that the business does get into financial strife, having security for those advances you've made to your company ensures that in a liquidation, you stand a higher chance of getting your money back. I'll now pass back to Sam to recap.
Righty, thanks very much, James. So, guys, to recap, James and I have obviously covered a huge amount of detail here, and some of it's quite technical, right? But the main message from today is that your balance sheet is fundamental in assessing your business strength. So there are so many things you can do to bolster or strengthen your balance sheet, including strategies to build profitability, improve cash flow, maintain solvency, and manage those shareholder current accounts. Our aim is to help you take what you've learned today and implement some positive change into your business. So, what are the next steps from here? Number one, doing nothing is not an option. Doing what you've always done is unlikely to yield the same results as you've had in the past. 2, remember, put that oxygen mask on yourself first. Planning for sustainable improvement starts with you and the leaders in your business. 3, make a clear plan for the steps you'll take to bolster or strengthen your balance sheet. 4, focus on what you can do as opposed to worrying about things that are outside of your control. And 5th, and finally, we are also here for you and we want to help. So the information in this webinar is general in nature and obviously no substitute for specific tailored advice and support. There are several ways that we can help you more specifically beyond today's webinar, and I've just put them up there on the slide for you. And it's not just limited to those. You can kind of get in contact for any number of things. Note there that the 5th one, the balance sheet health check, we've put in there and we can do free of charge. So it's just a little check of your balance sheet and we can indicate any problem areas of your balance sheet and we can kind of go from there. But at the end of the day, guys, we want to help your business succeed just as much as you do. And if there's anything on this sheet or otherwise that you would like to discuss that you think may help you in your business, please just don't hesitate to get in touch with James or myself. So at this point, we're going to answer some of the questions we've received, if we have received any. And so we'll just give you guys a couple of minutes, a minute or two, to consider your own balance sheet. And if there's still some burning questions there, whether it's related to your own balance sheet or general in nature, flick them through and we'll attempt to get through them all. So we'll just take a little second and we'll have a check. Okay. Just we don't have any questions at this point, but we'll just wait a minute or two. Just a reminder as well that this was the first of our quarterly webinar series, so you'll see these pop up in your emails every couple of months. There's a wide range of topics that we'll cover. So I think when this webinar is finished, there's going to be a little feedback sheet we've got. We want to get your feedback on what you'd want to see us present on. So that would be really helpful if you can chuck in there what you'd like to see. But we've got a few lined up, so look out for those coming through. Got any questions on there, James? It's all good. If there's no questions, that's fine. If you didn't want to send anything now, but you remember a question, you know, like an hour or two down the track or next week or something, on the start of the slides, we've got our emails, and obviously you've seen my email sending you the invite. So feel free to just get in contact with James or myself, and we can help you with whatever. And also you'll obviously have your regular contact at BDO. These guys know that we're presenting this webinar, so if you get in contact with them, I'm sure they'll be able to help out as well. So if there's nothing else, we'll just continue on, and I think we're ahead of time. So freeing up a little bit more of your guys' time to continue on with your business. So I just wanted to share, before we go, just this quote with you. So, business is many things, the least of which is the balance sheet. It is a fluid, ever-changing, living thing, sometimes building to great peaks, sometimes falling to crumbled lumps. It's pretty cool. So, guys, please make a simple plan today. Don't overdo it, but just commit to at least 3 actions that you'll take as a result of today's webinar. Write them down, give each of them an owner and a completion date. Remember, if you need our support, we're always here for you. So guys, just to exit, James and I wanted to thank you all for making the time to attend this webinar. We really appreciate it because we know that your time is super valuable. Please, in the next hour or so, you'll see an exit survey come through. So if you can fill that out, that would be awesome, so we can continuously improve ourselves and get your feedback on what other webinar topics you'd like to see from us. We hope we've given you plenty of ideas to ponder with your balance sheet and some clear next steps for you and your business. So thank you.